GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Welcome back to the show, Tim.
Jim, as always, thanks for having me.
The market's hitting new highs once again over the past week or so. Does that mean we're again on this ever-climbing train? It's only going to climb higher up the mountain?
No, not at all. You know, we did hit a new high, I think, on Monday on the industrials. People are, it seems like, you know, the feedback I'm getting anyway, people perceive this as a breakout. And, you know, I'm hearing that, you know, even seasoned market analysts are turning bullish. I don't know. That's just what I'm hearing from some of the feedback I'm seeing. I'm not convinced of that. I mean, not at all. I think the Dow theory is screaming at us. I think the signs are everywhere. I think that it's been, you know, I stick to my guns because of my work and the discipline. I think that in hindsight, people will look back at this and say, why didn't we see it? But, you know, I did printed a chart, went back and looked at a couple of things, and what people don't realize is that the worst declines in market history have come from the markets being at new highs. And, you know, I'm not using that as an excuse, or that's not the basis for any kind of prediction or anything like that. I mean, the markets have not been on solid ground for a long, long time. And, I mean, evidence of that is, I mean, just look at the actions by the Fed. Look at the fact that they have extended, manipulated, and inflated this to be the longest four-year cycle in stock market history. I mean, things were fine. Why would they be doing the things they're doing? I mean, I've said that 1,000 times. And so that's number one. But the fact that we're at a new high is not some savior for the market that everything's okay. It's not a sign that everything's okay. I'm simply saying that the worst declines in history have come from the market, you know, with the market you know, following a new high like we are now. So, looking at some examples of that, I actually went to the trouble of printing some charts and made some calculations. But, you know, with the market at a new high going back to 1901, it fell 44% into a four-year cycle low in 1903. 1906, there was a decline of 42%, fell from a new high, 42% into a low in 07. 29, we all know about 29, fell 88%. After a new high. 1966, that secular bull market top, there was a 24% decline following that new high. In 73, which I've equated this advance to a much larger scale version of the 73 of the advance into the, you know, the 73 high, because of the cyclical phasing and the Dow theory phasing. But anyway, from 73, that was a four-year cycle top, a correction within a secular bear market that carried the market to a new high. And then from that new high, we dropped into the final four-year cycle low and the final four-year cycle low into a four-year cycle low, and the final bear market bottom carried the market down 46%. 1987, 41% decline. 2000, all-time high, 35% decline. 07, 50% decline. And what I'm saying is, you know, is this is just, you know, the fact that we're at a new high is that, you know, we have the Dow theory non-confirmation. We have the most extended move in stock market history ever 4-year cycle advance ever. Never extended to this degree. Never seen the level of manipulation to extend the move. The volume characteristics of the market are clearly bearish and have been since the 2000 top. And we've talked about that before, and I think I've even posted charts and articles. The Fed's actions themselves is an indication that things aren't right. The sentiment that people think that this is a breakout, the cyclical structure of the market itself, the statistics associated with these extended moves, the non-confirmation itself, and the non-confirmation between other sectors and averages. These are all warnings. And here we sit at a new high, and everybody thinks it's a breakout. So, while I don't know how much longer the can be kicked down the road, I am 100% confident of what the Dow theory and these other warnings are telling us. And I stick by the statistic until this Dow theory setup is blown out. And it may or may not be. I guess that remains to be seen at this point. Right now it stands. But if it sticks, then I stick to 65 to 70% decline that's going to come seemingly out of the blue and take us down and take us down hard. And I think most asset classes are going with it.
Well, somebody pointed out in this particular trading session, there's usually some kind of darling, like about a year ago, the FANGs were the hot thing, the biotechs before that. Right now, even though we're hitting record highs, there are no new darlings there for you to invest in.
You know, that's a good point. In 2000, it was the .com deal, and you know, telecom was hot. Yeah, I don't know of any darlings now. I really don't.
One of the problems, too, I guess, is what I call endless quantitative easing. Japan just announced a program. Before that, it was China. Before that, it was Europe. It seems as soon as there's any sign that the markets are going to decline, somebody goes and kicks in billions of dollars that, of course, make the billionaires richer and the average investor poorer.
And that's absolutely correct. And that is not an excuse. You know, I've watched this for a couple of years now. The market has been set up and trying to crack for a couple of years. And every time we get to that important technical juncture, overnight, the Bank of Japan will make an announcement or whatever. Or there's some emergency meeting and somebody says something somewhere or does something. And it always happens when we get to this little juncture. And so I've been watching that for 2 years. And at the same time, while they've managed to continue to extend this thing, they haven't fixed anything. And if you go back and look, you know, it's been a while since we've talked about it, but the underlying economy has not changed. The fact that this is a secular bear market has not changed. It's all a mirage. And all they've done is make the bubble bigger. So I don't know, you know, can they come out with some news and, you know, extend it another week, month, 6 months? I don't know. But what I do know is that I'm 100% confident of the setup and what Dow theory and all these things are telling us now. And until that's blown out, we don't know if it's going to be at this technical juncture or the next one or the next one. But at one of them, it's going to fail, and it's going to fail big. And once it happens, once Humpty Dumpty falls off the wall, there will be no putting him back together again.
We'll have more with Tim Cyclesman Wood right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, with all this quantitative easing that keeps happening, how can a person know if the numbers they're seeing in the markets actually reflect what's going on in the markets?
Well, I think common sense tells us that it's, you know, with something being manipulated, and if it's has to be manipulated to keep it up with the quantitative easing and the jawboning and so on and so forth, then obviously it's not real. And how do you trust that? I don't know any other way to say it. Technically, this is a train wreck waiting to happen. And, I don't know. That's the only answer I have. I know what the statistics tell us. I know what the Dow theory tells us. I know how extended it is. I stand by that work.
Both Hillary and Trump are talking very protectionist if they win the election. And, of course, that's bad news for Canada. We're the U.S.'s biggest trading partner, but does the U.S. even recognize that and how integrated Canadian and U.S. factories are? They both rely on each other's parts on same-day delivery. They don't have warehouses full of parts anymore. And if you hurt one side of the border, you hurt the other. And you may not even realize you're doing it.
I agree with you. I mean, it's one world. I mean, I agree.
Protectionism, I think, doesn't protect anybody in the long run, does it?
I don't think so. And it's kind of like the markets. I think you should let the marketplace be the marketplace and let the, have a free economy, and a free market. And I think the best thing that government can do is get out of the way and let the marketplace take care of itself.
It seems to me every time governments try to interfere in the economy, they just make things worse. I remember in the late 70s in Canada, inflation was running rampant. The Prime Minister, Trudeau, the older Trudeau now, brought in wage and price controls. Well, all that did was keep down wages, but prices still went up.
That is correct. And you said that, the more they do, the worse the worse they make matters. And an example of that was, following the 2000 top, and I've said this 1,000 times, but it dead gummit, people need to listen. And it's a true story. I mean, it's just a fact. But, they extended the 4-year cycle into the 2007 top coming out of the 02 bottom. And I said all along, it's only going to make matters worse, only going to make matters worse, only going to make matters worse. Well, in that case, we got the setup, we got the DNA markers, bada bing, bada boom, and it came apart quick. But it did make matters worse. And we did go below the previous 4-year cycle low, the 02 low, just like the statistics said we should. This time, I think their actions are telling us that they know they've made matters worse, and that's why every time it starts to crack, you see some kind of jawboning or some kind of news or something to try to influence the market and keep it going. It is, like I said, I don't know what other words, how else to say it. It is the most extended, most stretched 4-year cycle advance in history, and it has to unwind. It's going to happen. And so what they have done once again is made matters worse. They just left it alone, then nature would have taken its course, and we would be coming out of this now. But what they have been fighting, the reality of the situation is real simple. When you look at the volume characteristics of the market, it peaked in 2000. That was the secular top, 2000. When you look at the underlying, we've talked about this so many times, the volume characteristics tells us that. The job participation rate tells us that. The velocity of money tells us that. The economy peaked in 2000. It all topped. And what they have been fighting since then is deflation. That's the enemy of the Fed, is deflation, or the world central banks. Deflation. That's where we're at. And so all of this extension, all of these efforts, everything they've done is to try to fight deflation. And yes, they've been successful to some degree. Absolutely. The market's it was at a new high 4 days ago. Granted. But it's the biggest bubble ever, and it will deflate.
Is there any place people should be putting their money right now? Of course, gold will be more popular as the markets decrease or do decrease. But again, people want to try to time it. Would it be just a good idea to make sure you've got 10% of your portfolio in gold no matter what?
That's probably not a bad idea. I think the big, we've talked about gold before. I said I think we're at an intermediate term top. It's really not gone anywhere since then. But I do think that there's a much better buying opportunity down the road with gold for long-term holders. Absolutely. I have no problem with gold, but I think cyclically speaking, there's a lower low, probably with a 9-year cycle low later this year, early next year. And I think everything is setting up to go down into those lows. And when I say everything, I mean the whole commodity complex, I think, has got another trip back down. And, I'm not convinced maybe this is the juncture in which, equities break and everything goes down together. I think, the safest place to be is really cash. Because I think just like 2007 and 8 and into 9, everything went down together with those deflationary forces once control was lost. And that's what's going to happen again. Somebody sent me the Jim Rogers video. He said, sell everything, run for your lives. I have to agree with that. I was kind of funny from my seat, but I agree with him.
What's going to happen with oil? We've seen it creeping up again. It's getting close to the $50 mark again. Is that something you expected?
Yeah, yes and no. I mean, here's how, and sometimes in my work I can get a price target. Sometimes I can't. Sometimes, it just depends on the particular setup. And without going into those details, I mean, I knew that we were at an intermediate degree low, and I had an intermediate degree buy signal, so I knew it was going to bounce. No question about that. But I also knew that seasonality and based on some of the higher, cyclical work, that, crude oil had made a major top back in June. And there's always a counter trend bounce or a counter trend, once you get a higher degree cycle top, there's always a counter trend bounce and a retest. I mean, it's just, nothing moves in a straight line, and, lower degree cycles retest highs and vice versa. And that's what this is, I think. It's a bounce, and, it's going to bounce until I get another sell signal, and then I think crude oil is going lower.
Well, gasoline prices really have been very moderate this summer. I'm calling this the year of the driving vacation. Summer started early for most of North America. I've never seen more recreational vehicles on the highway before in my life. I think people are taking advantage of the lower gasoline prices and are enjoying the U.S. and Canada, which in the summer, as you know, the most beautiful places in the world.
Well, I'm certainly not going to argue with that. Living where I live, and I'm glad that school is starting, and that the tourists are getting away, because I don't mean that to sound ugly, but I agree. There has been a lot of people on vacation this year driving, no question.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com radio. You can find us on Twitter at TalkDigitalNet or check out our YouTube channel, Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.